Hi, this is Ricardo Lopez. I'm a broker associate with Hoven Real Estate. Today, I want to talk to you about this whole question that I keep getting about should you buy with higher interest rates? Let me share the screen here a second. All right. So basically, the question is, should I buy a house because interest rates are higher? And people are saying, well, I better wait because now it's not a good time. In my experience, there are reasons to buy. If you're able to buy, you should buy a house. Long term, it's always a good idea to purchase a home. But let's take a look at this a little bit, okay? So bear with me. This is going to be quick. I'm going to talk to you a little bit about economics here. So here we have the basic law of supply and demand. Okay, supply and demand, what it does, and I'm going to keep it very simple because I know people are going to tell me there's a lot of things that go into that affect this, but I'm going to keep it as simple as possible. So basically, here you have, say you have a given price, and at this price, supply is, say, right here. Okay, that's the supply is the number of people that are selling a house, basically the inventory. All right, so the inventory here tends to be low. Now let's take a look at this here. This is the demand, all right? So at that same level, this is quantity is the number of people that are willing to buy a house, that want to buy a house. Now, as you can see, this is higher, all right? So what we have here is a situation in which the supply, the inventory is low and the demand is high. What happens here? What we have here is what is called a shortage. Let me see if I can write here. Short. I better not try to write here because it doesn't work very well. All right, you get the picture. So you have a shortage. What a shortage means is that is a seller's market. Okay, it's a seller's market because you have basically low inventory and high demand. What a seller's market does is that it drives the prices up. Why? Because more people want to buy, and in order to buy, they have to offer a higher price in order to get, say, there's 200 people wanting to buy a house, and there's only 100 houses for sale. In order for these people to try to buy, they're going to have to offer a higher price. And then we have bidding wars and things like that. So on the other end of the scale, what you have here is when the demand, and the demand means that is the number of people wanting to buy is low, and the supply, which means that's the number of people wanting to sell, that is high. What we have here is what we call a buyer's market. Okay, so what we try to get is the equilibrium. Okay, equilibrium means that there's as many people wanting to buy as there are people wanting to sell, and we're all happy, everybody's happy, the sellers can sell, the buyers can buy. Realtors, we love that. But that's what we strive for. Usually in economics, we're somewhere in between, and we're working with these forces of supply and demand. So what's happening right now? All right, so we've been down here. We've been in a seller's market down below. All right, that's what we have been. Right now, the supply, it's going up, inventory is going up, and what is happening is that the prices are coming down. Now, the reason this is happening is because interest rates change. When interest rates change, what you're doing is moving the curve of the demand curve to the left, okay? When you move the demand curve, now imagine that the equilibrium here was right here in the middle, right this one here, and now the equilibrium went down, okay? So prices and this is just the law of economics, prices are coming down. Now, so we agree interest rates go down when, I mean, interest rates go up. I'm sorry. When the interest rates go up, it shifts the demand curve to the left and the prices go down. All right. So what does that do to us? Now, let me just move here. So this is something that, we are looking at. We're looking at the interest rates going up. So say one of the things that I want to point out is that every time there is a change of interest rates of 1 percentage point, okay, the ability to buy, that's your buying power, goes down by roughly 10%. So the difference between this number and this number here is about 10%. If 10% of 334,000 would be about 33,400, and if you deduct that from that, you get, about that amount, close to it. So every time a percentage point goes up on the interest rate, the buying power goes down. All right. And this is keeping, of course, the payment the same. So say you want to pay $1,500, the interest rate goes up. With that $1,500 payment, you were able to buy a house at $334,000 if the interest rate was 3.5%. Now, if the interest rate goes up to 5.5%, then with the same $1,500,000, now you can only afford to buy $264,000. Now, this is very simple. We're just looking at the principal and interest. We're not looking at tax and insurance in this $1,500. So, but this is just an example to keep it simple. So what is happening right now? So say the interest rates, well, I don't have to say it, the interest rates are going up. As the interest rates go up, you can afford less, correct? We're clear on that, you can afford less. But on the other graph, when we were talking about economics, we know that the prices are going down. So say you can afford less, but at the same time, the prices are going down, all right? So if prices are going down, let's keep it simple again. Say the interest rates go all the way to 5.5%, and now the prices may go down 10, 20%. Say they go down 20%. Now you can buy a house at the same amount that you were able to buy a house before, because $264,000 may buy you the same exact house that was before $334,000. So what is going on here? Yes, the interest rates are up, but if the prices of the houses go down, and we're already seeing them go down, and basically, if you look at economics, they will go down if we follow the science of economics. So now you're buying a house that is cheaper, all right? So you're buying a house right here that is a lot cheaper, and you're paying higher interest rates. But what will happen? Say in a few years, or maybe a year, interest rate goes down again. You refinance, all right? So you can always refinance. The interest rates is not a set deal. However, what you pay for the house doesn't change. So if you buy a house at a cheaper price, at a high interest rate, and it's the same house, you are better off, because later on you can refinance. The interest rate that can change, but the price of the house, it's great if you got it at a low price. All right. So this is a little bit of an example of how I see it, how it works. And if you have any questions, please let me know. Thank you so much. Talk to you soon.